Today, I wanted to talk about two effective ways to destroy capital. You heard me right. It's an unfortunate discussion that I think many people have been putting off or denying needs to be had, which is that after very extended periods of expansionary monetary policy like we've had for more than a decade, certainly here in the US and of course elsewhere around the world, there comes a time when that monetary base has to contract. This month's Forbes article that I've written, as well as a research highlight on our website, discuss this phenomenon when you are transitioning from a expansionary monetary policy environment, and then going towards a more contractionary one. And it's quite real. So just as easily as the money was injected into the economy, both domestically here in the US and of course globally, is just as easily as it is removed from the global economy and from the domestic economy. And while the Federal Reserve's balance sheet has really ballooned from about 800 billion a decade ago to over 8 trillion today, and the Federal Reserve has been doing a very diligent job in raising interest rates in order to stamp out inflation, which is a byproduct of expansionary money policy. Now we're going in the other direction, and things get a little weird. That's a technical term. Things get a little strange, because when you're mopping up this excess money in the system, there are things that will break, and there are really two effective ways to destroy capital. And the first way to destroy capital is to drop bombs on a city. And unfortunately, there are places in the world right now that are having bombs dropped on them, and it is destroying a tremendous amount of capital, hard assets primarily, but also a lot of other things. And those things will need to be replaced. And obviously that costs money, and there's production involved to do that. So ultimately, there's a positive side to the destruction of assets through bombs. It's a very painful and difficult process, but nonetheless, there's a positive on the other side of it in terms of production, in terms of even wealth creation. But there's another way in which capital is destroyed. Capital is destroyed through defaults or bankruptcy. So you can have bombs or bankruptcy, bombs or default, which is kind of a derivation of bankruptcy. So that's that latter one, default or bankruptcy, is something that we have a tremendous amount of risk to experience domestically here in the US economy. And of course right now you're hearing quite a bit about this with the US Treasury Secretary Illan talking about a debt ceiling limit that most folks are using June 1st as the deadline for this decision. No one knows exactly what the date is, but the point is Congress needs to get together and make sure that the US government is honoring its debts and not defaulting on its debts. And if it did default, it's our impression that it wouldn't be the end of the world, because the US government would make good on its payments when eventually Congress would get out of its own way and figure things out. But in the meantime, it's a question mark of how they're going to negotiate their way out of it. But setting aside the US government aside, which is a big set aside, you have all of these corporations in the United States that borrowed trillions upon trillions of dollars over the past several years. And they borrowed at very, very low rates and financed that at 1.5% interest rates. Well, today those same companies are having to borrow at 4 or 5%. And so that's a significant increase in the debt service payments that will have to be made, and something that is a tremendous challenge for many of these companies that haven't seen geometric growth of their revenue or expansion of their profit margin. So there's a challenge there. And when you compound that with commercial real estate and the vacancies that are still very much present in most metropolitan areas here in the United States, that are seeing maybe only about a third occupancy, or at least half at the very best, there's a repricing there on those assets that has yet to really be fully incurred. And obviously there's financing associated with those buildings that the banking system has taken on. And so there's a lot of commercial mortgage-backed securities that also have and are part of this refinance risk in the economy. So the bottom line for all of this is that there is a high potential for a lot of defaults and the need to have a workout of some kind between the debt takers and the debt holders to be able to recoup some portion of those funds that have been lent. And all of this is being done in a higher interest rate environment, and an environment also where there's, yes, utilization of the assets. So this is how you destroy capital. This is how capital basically just vanishes into thin air. It was created out of thin air, and it returns to thin air. And this is just a part of the monetary cycle. This is not a new thing. This is the ebb and flow of a monetary base. And this is what central bankers do, and how they manage economic growth, how inflation is kept in check over periods of time. And from our perspective, the Fed is really doing everything correct in increasing interest rates. It's also being very clear that it is increasing interest rates and will continue to do so until it sees inflation come down to its target levels. They state it to be usually around 2%. I think that's a bit too optimistic for them, but maybe we see 3.5 by the end of this year. Inflation rates, but that will mean quite a lot of unemployment, significant increases in unemployment, and also significant increases in defaults or things that are not meeting payments as promised from a lending perspective. And as we sit here today, the credit markets have not reflected at all this increased level of risk and this true increase of risk when it comes to capital loss and being returned money that is less than you expect to be returned when debt matures. And of course, that will have implications for the equity markets as well. And so from certainly our perspective, we're looking beyond the US market to other markets that don't have as significant of a debt profile or debt load on their corporations or even their governments. And that's an important area to take a look at and examine what your own exposures may be in your portfolio. And hopefully you found this helpful. And of course, if you'd like to have us analyze what you're doing or engage with us in this dialogue further, don't hesitate to reach out to us at 310-795-0622 right here in Century City, beautiful Century City, or go to our website at alignwealth.com. That's ALIGNE wealth.com, and feel free to submit a contact to us through our webpage. Thank you so much for listening to this update, watching this update, and we'll do it again next month. Take care.